Okay, assuming that you have last period's cash flows that you have calculated. Now, the next step is how are you going to estimate their growth rates? What are those cash flows going to be next year? What are they going to be 2 years from now, 3 years, 4 years, 5 years, and ad infinitum, so to pretty much to infinity. So in that case, how do we obtain these estimates is going to be the next thing that we need to worry about. And can we use a single growth rate for all of the different cash flows? The answer is not necessarily. So let's look at the details. Where do we find these growth rates? Well, the most typical places to start, one, let's look at the past. So historical growth rates in the earnings that you've been using, take a look at them and try to determine, do those growth rates look like something that can be used? And typically you probably don't want a single one from this year all the way to infinity. You'll probably separate out that period into at least two. So I don't know, maybe 5, 10 years, and then from that time onward, or perhaps you'll do it in a number of steps. So, the next 3 years, and then 10 years after that, and then to infinity and so on. But especially looking at the past growth rates, especially for the near future, probably gives you a pretty good starting point to use. What else can you use? Well, what if you have some estimates of others? Okay. In particular, you might be able to find, especially for developed markets, you may be able to find analysts estimating what the growth of particular companies' earnings are going to be. So yes, you might be able to find their growth in EPS especially. But again, this is typically in more developed countries. In Turkey, you might be able to find them for some of the companies, probably not for all of them. So yeah, that might be something to use. We will come back to this. We will talk about this. And yes, analyst estimates also are, if you can find them, are also typically a good thing to use, especially again for the near future. And then you may also be able to use, some statistical tools, just like looking at the past and using that to forecast. But if you have analyst estimates, especially for next year and maybe, up to 3 years, those may be superior to most of the statistical tools that you can find. And then finally, don't forget to look at the fundamentals, because there is a fundamental relationship between how much a company is reinvesting and the profitability of the things that they're reinvesting in and the growth in earnings that is leading to. So we need to make sure that we are being consistent between our forecasts of investments, of growth, and of profitability, and the relationship between these. So yes, all growth in earnings can be traced to two fundamentals. How much is the firm investing? Okay, so are they investing in working capital, in fixed assets, in equipment, machinery, and so on? And how efficiently are those functioning? How much is it helping you produce? How much is it helping you sell? How much profit is being generated by what is being produced and sold? So these need to go in. So how much are you investing, and what type of returns are these investments, are these projects bringing to the company? So looking back, the first alternative was look at the history, look at what's been happening in the past, and try to use that as a forecast. But again, just like we were talking about the kind of risk-free rates and the T-bonds and stuff, when trying to estimate what, the RF should be or the risk premium should be, well, here we basically have the same problem. Should we use an arithmetic average or a geometric average? If you're estimating just 1 year, an arithmetic average is fine. But if you're trying to estimate, the growth rate for a relatively long period, then geometric average may be more appropriate. Or you may also use some other type of regression model, which uses some of the fundamental factors affecting the growth rate and try to go from there. Historical growth rates can be sensitive to the period that you're examining. So are you using 1 year? Are you using 5 years? Are you using the last 10 years? Are you using, a period before that when growth is fast or when it's slow? Where are you starting from? Where are you ending your estimate? All of these can have significant effects on the growth rate that you end up calculating. And some things which can be especially problematic, which we will see with some numbers, is what if you have the earnings number or the profit number switching back and forth between positive and negative numbers? Wow, that can be real problematic because anytime an earnings number goes from positive number to negative number, you basically have a negative growth number, right? Yes, but the same thing also happens when you switch from a negative number to a positive number. Again, the growth rate appears as a negative number, whereas it's something good happening. You're going from a loss to a profit. So typically when there's a sign change in the numbers that you're trying to calculate the growth rates on, that may be a problem, and we'll look at how to deal with those. And then maybe most importantly, the effect of changing size. For a small company to grow quickly is relatively easy, especially if you're very, very small. Let's say you go from 1 lira of sales to 2 lira of sales. Wow, that's 100% growth, right? But it's just adding 1 lira. You could easily have gone to 100 lira or 1,000 lira or even 10,000 lira in a very short amount of time. But percentage-wise, these, seem to be tremendously big numbers. But as companies get bigger and bigger, as their market share, tends to become significant, don't forget that almost all companies slow down as they get bigger. Otherwise, they would end up taking over the whole industry quite rapidly. So please be aware of these. So arithmetic versus geometric growth rates. So here we have 5 years of data, or sorry, 6 years of data. This was for Motorola in the late 90s. So they start out with revenues going from 22 million to almost 31 million. Excuse me. They also have the numbers for EBITDA and EBIT, right? So let's look at the growth rates, the changes in each of these. So here, notice that, we have these numbers, and there was 1 year where they actually, their revenue went down and then it increased back up. But percentage-wise, so from 94 to 95, they grew more than 20%. Then they grew another, 950, 940. But, percentage-wise, it was only 346, then 651. Then here they had the slowdown and then a pickup. Oftentimes after a slowdown or after a down year, if economic conditions correct themselves, you can have big jumps afterwards. But over these 5 growth rates, if you take their average, 708, their geometric average, 682, but notice that it has a high standard deviation. Why? Well, just look at it. The range is from 21.5% to minus 1.3%. That's a pretty big range around its average of 7.8. Looking at EBITDA, okay, so while revenues were growing, EBITDA was also growing, but not every year. So there's growth here, and then it shrunk. But even while revenues were growing, how can EBITDA decrease? Well, apparently revenues increased, but costs increased even more. So during this period, their EBITDA did not go up. It actually went down. And then it almost didn't change here. And then actually here this year, when they had a slight decrease in their revenues, look at this. Wow. This is probably indicating that in a down year like this, when they have some costs which don't change, remain high, and that led to almost 30% fall in EBITDA. And then after this down year, though, they recuperated in revenues, and look at how much an increase in EBITDA this brought. So in EBITDA, notice that a lot of the fluctuations are bigger. So the averages, arithmetic average is higher, but notice that the geometric average isn't higher. And you can have these type of differences, especially when there's a lot of variation, when there's going backward and forward between positive and negative numbers. These can be problematic. And look at the standard deviation, for more than 41% around this average of 10.8, 10.9. And typically you'll see this revenues, the percentage changes there will tend to have less standard deviation than changes in EBITDA, EBIT, or if we had net income numbers. So look, coming down to just EBIT numbers, look at this. Revenues, increasing except for 98. And here, up, down. Wow, this year, when it went up almost 3.5%, expenses apparently stayed up high, and this actually led to a big decrease in EBIT, almost 1/3 reduction, and then another decrease, and then a huge decrease, almost EBIT becoming almost zero. So they didn't lose money at the EBIT level, but they came pretty darn close to zero. And then look at this, 291% growth in 1999. So the arithmetic average, very, very high, but the geometric average, look at this, only 4.3%. Standard deviation, huge. So yeah, it can, if you look at these, they can be quite different, especially if there's big changes between positive and negative numbers when you calculate, its geometric average. Another good example of that, which is very easy to understand. Let's say that you have a company that starts out with, let's say, net income of 1,000. And then net income, let's say, in the next year doubles to 2,000, 100% growth. And then the next year, it goes down 50%. So it goes from 2,000 back to 1,000. So what's happened? We started at 1,000 net income, went up, and then went back down to 1,000. So we're at the same point. Tell me what the arithmetic average of the growth of this is. 100% minus 50%. Add them up. We have 50% divided by 2, 25. So the average growth rate over 2 years is 25%. Sounds good, not bad, but be careful. Did you actually grow 25% for 2 years? Starting at 1,000, I'd expect to be then at 1,500 or maybe even more if you actually do the compounding. But remember, we're back down to 1,000. So if you were to calculate the geometric growth rate, or basically, if you were to calculate the logarithmic growth, 1,000 up to 2,000, then back down to 1,000, the logarithmic rate, so basically ln P1 over P0, or in this case, P2 over P0, it starts at 1,000, finishes at 1,000. So basically, there has been no growth, right? Yes, that's what we're trying to show. So you need to be a little careful about using growth rates. Perhaps you might want to use logarithmic growth rather than simple growth rates in some of these numbers. regular growth rates or regular price increase percentages, the distribution of them is not a nice bell curve. It has a lower bound at minus 100% because prices can't fall below zero, but the upper side is unbounded. So when you take its logarithm, it looks nicer. It goes out to plus minus infinity. So something to think about. Maybe use logarithmic growth rates. And another thing that we want to notice, okay, so here we have Cisco, and from 91 all the way out to 99, and these are the earnings per share numbers. And they've basically gone from 1 cent earnings per share up to 32 cents. And these are the logs. And in this case, they're basically trying to fit a line to this. And if you use just the actual EPS numbers, this is what you get. And you get a growth rate of 30.5%. Average EPS 91 to 99. So divided by 13. This is how much it has increased, coming from this over time on average. And they use this as the average price over this period. Whereas if you were using the natural log and fitting a line to that, you obtain this rate. Okay, so this goes back to the example of if something switches between positive and negative numbers, what should you do? What should you plug into those numbers of which you're going to take an average? So Time Warner, 96 to 97, our EPS was a deficit of 5 cents. So it was minus 5 cents earnings per share. Expected earnings per share for the next period is going to be plus 0.25. So earnings per share went from minus 5 cents to plus 25 cents. So what is the growth rate here? If you use the mathematical formula, it is this minus this. So 25 minus 5, 30 is the total change. And divided by the old price, the beginning price. So 30 cents divided by minus 5 cents. So if you use the mathematical formula, the growth actually is minus 600%. Anytime you have a sign change like this, that's what you would end up with. But it's actually growing, right? It should be a positive number. So some argue, oh, no, that should be plus 600%. Well, not according to the formula. Or you might say, some people say, okay, if there's a change between a negative and a positive number, then use whichever one is positive down below. So in that case, divide, this 30-cent increase by 25, and you would get this alternative, plus 120%, if you use that. But in fact, just leaving it alone, leaving it NA or something like that, is probably more appropriate, because when you have something changing between a positive and negative number, it doesn't really give you something meaningful that you should be using in your spreadsheet, in your calculations. Similarly, if I have some years where the starting point is very close to zero, for example, I had 1 cent of profit in that year, basically equal to zero, but it's not zero, so 1 cent. And then the next year, we had $100 or $1,000. Wow, that percentage-wise would be a huge positive number. Okay, but especially if it's an outlier, that number isn't meaningful, isn't going to be representative of what we expect to happen again in the future. So anytime your starting point is very close to zero, a small positive number, that following year's number probably isn't a meaningful number to use in calculating averages. And then for negative earnings, what would you do? Again, consider that, probably leaving it out. So this is the example of Callaway Golf Company. They make golf clubs. And look at this. Their net profit from 1990 to 96 had been growing by huge amounts. Look at this, 255%, and then 200%, and 113, and 89, and it slowed down, but still 25%, 25%. And if you calculate over this period, and let's say, oh, if we calculate the arithmetic average, it's going to be, wow, very high. So maybe use the geometric. Wow, still 102%. So what should we do? Should we use, I don't know, this 100% growth expected out into the future? Well, if you look at the trend here, notice that the high ones are back here, the newer ones are much lower. And that's what happens when you grow. This company has been becoming bigger and bigger. And if you expect this 100% growth rate to continue in just a few years, the value of Callaway Golf or the profit of Callaway Golf probably would become a bigger number than the entire golf club industry, or maybe even the sports industry, or if you continue it out far enough, maybe of the economy of the United States. So you want to make sure that as the company is getting bigger, that you slow it down to the overall industry growth level or to the economy's growth level in general. Yes. So if we were to take that out for a few more years, continue the rate up to 2001, look at this, the net profit becomes this big. So basically more than 4 billion. But the entire industry probably might be making that much. So it's not a very realistic assumption to continue out, these things like a straight line. So what else did we say we could use? Well, if you have analysts that are following your company, then definitely taking a look at what they are estimating. And the research tends to support, especially for the near future, analyst estimates do a pretty good job. So find under or overvalued stocks, but while doing this, they also make announcements about what they expect to happen to particular companies. So forecasting the EPS of a number of companies that they're following is typically among the announcements that they make. So what else do we have? Yes, forecast expected growth in earnings per share for 5 years. Analysis information goes into, it's far more limited. So basically saying, be careful, they might not have much more information than you or I do. So why trust them more? But still, at least for the next few years, analyst estimates seem to do a pretty good job, is the general findings. So if you have something like, Zacks or IBS estimates, or if you go on to Bloomberg and so on and find, their growth estimates, especially for the near future, especially in developed economies, yeah, these typically can be pretty easily used and defended. So here is some results of some research. Analyst forecasts of EPS tend to be closer to the actual EPS than a simple time series model. Okay, so using simple statistics, the analysts seem to perform better, but differences tend to be small. So here are a few studies that examined this, and these are the forecast errors of the analysts and of the time series model. And notice that the analysts seem to have a smaller error compared to the time series, simple time series models. So yes, if you have them, yeah, for the near future at least, you might want to use them. You might consider using them, but be careful. The advantage doesn't last for all periods and all time and for all companies. The advantage decreases with forecast period. So next quarter, they're much better. Next 5 years, they might be slightly better. Tends to be greater for larger firms, So if it's a large company being followed by many analysts, they tend to do a pretty good job. But for small companies that not many analysts follow, they do maybe a little slightly better than the statistical series. And finally, the advantage tends to be greater at industry level than at the company level. So forecast of what's going on in the industry or what's going on in the economy are better, are closer than if they're actually forecasting the performance of an individual company. Yes, forecast growth and revisions tend to be highly correlated across analysts. So if I'm going to make my expectation known to the world, and I notice that everybody else is saying this and I'm saying this, I'll probably look back at my records and see, oh, why did I estimate it that high? And often you will see that all of a sudden I might come closer to the average of the estimates in the next announcement. So typically, many of them are quite close to each other, analyst estimates. Are some analysts better than others? Here was a study where they have a group which are announced to be all American analysts. And these are voted on and chosen by this group. And interestingly, once they become a member of this group, their performance is good, but not necessarily before joining and not necessarily after leaving. So I don't know, there is not a lot of evidence that some analysts are much better, except there's a few people who have been found to have excellent performance for very long periods of time. So some investors do seem to have a significant advantage over groups, but not very many, not very common. So what kind of problems can you have? So one, tunnel vision, becoming so focused on the sector and valuations within the sector that you lose sight of the bigger picture. You tend to, start believing all the stories and this is so important and it's going to continue going this way, when sometimes there are big turns, up or down turns that affect the industry. They tend to miss these. Lemongitis, so strong urge felt to change recommendations and revise estimates when other analysts do the same. When you see that, your competitors are changing their estimate or saying, they used to say buy this and then they sell, you'll look back and see, if they change, should I change as well? And then you'll see many people start to follow as well. Stockholm syndrome is actually the story of somebody that gets kidnapped and then starts identifying with their kidnappers. When this happens with the investment analysts, they start believing all of the stories that the companies that they're following start telling them. So their job is actually to be objective, but after a while, they tend to become friendly with the companies or enemies with the companies. And as a result, tend to believe a lot of the stories or never believe the stories if they're enemies of the companies. Factophobia is when you run into evidence which is contrary to your expectations. You tend to say, oh no, there's a problem with that data. Okay, so facts which don't support what you're doing tend to be ignored. Dr. Jekyll, Mr. Hyde, these are analysts which sometimes forget that their job is to give honest opinions about buy and sell decisions. And they start thinking that, oh, if I give, this company actually isn't doing good, they're doing bad. But if I say that, they won't work with my company. They won't give business to my company. Well, that's not your job. If your job as an investment analyst is to give honest opinions about these companies, it is not to make friends with the management of those companies so that they start, using your company for other things. So it's not to bring in investment banking business of those companies to your company. But many times this gets forgotten. Okay. So propositions about analyst growth rates, some suggestions. One, there's far less private information, far more public information in most forecasts than is generally claimed. Yes, they're making a lot of money, so they should have inside information, right? Maybe they should, but do they? Most of them don't. Prop 2, biggest source of private information for analysts remains the company itself. So if they do have any advantages, it's the information which the company feeds to them. And typically they feed you information, one, to keep you happy, and especially they leak good information more often than negative information. The only time they'll leak negative information is to prevent overreactions from happening. So another problem. Prop 3, there is value to knowing what analysts are forecasting as earnings grow for a firm. There is, however, danger when they agree too much, when they agree too little, okay? Yeah, when everyone agrees and nobody agrees, who knows what's going to happen? Okay, so this is the fundamentals examination of the growth rate. What makes it up? Well, think of it this way. So we have a company who has, 1,000 or maybe 1 million or 1 billion invested in existing projects. So these are the assets of the company, if you will. And their return on investment for these projects is 12%. So what happens? 1,000 times 12%. The earnings of this company are $120. So next period, let's say that our old investments continue to perform the same way. So the earnings from these are going to continue to be 120, but they make some new investments, which also have a profitability, a return on investment of 12%. So in that case, it is the new investments which are going to bring the new return, which causes an increase from 120 to 132. Notice the old projects, old profitability continue. The new projects with the old profit rate, that is what is creating the difference. So this $12 increase comes from $100 invested in new projects, earning 12% return. So we can say that the total change in earnings, the first portion, which in this case we don't have, the old investments, if their return on investment had gone up or down, this could be causing part of a change. In our case, there is no change. So change in ROI from current to next period is 0%. The old projects have not caused any change in earnings, but it is the new projects times the ROI, which is creating the change in earnings. So anytime we want to estimate growth, we need to look at old investments. Has there been a change in their profitability? And then second, what are our new projects and what is their expected profitability? So it will be the sum of these two sources which will create growth or shrinkage in earnings numbers. And that is the fundamental relationships. So this goes back and tries to make it more into a formula. And notice here, investment in new projects over the current earnings level. Okay, so $100 invested and out of the current earnings of 120. So this, how much of the 120 is kept in the company and reinvested. So this is called the reinvestment rate. Multiply that by the ROI, return on investments. So that would be earnings over amount invested in new projects, or if it's the same in all projects, basically will give you the change in earnings divided by the current earnings level. So in our example, 100 over 120, the reinvestment rate of 83% is being kept and reinvested in new assets. The ROI has not changed, it's 12%. And this leads to $12 of new earnings divided by the current earnings level of 120, which means that the growth rate in earnings is 10%. So the growth rate will be a multiplication of how much of your earnings are being kept, reinvested in the company, multiplied by the return on investment. So that's the formula we will be using quite a lot. But be careful, anytime the ROI is changing, you also have an extra term which goes into the equation. And in that case, you have investment in existing projects multiplied by the change in ROI. So this is the addition, the change in earnings caused by old projects improving. These are the new projects with their new ROI. And then you divide them by investment in existing projects times the current ROI to give you the growth rate, change in earnings over current earnings. So in our example, if this had gone from 12 to 13% ROI, both old investments are improving their performance and the new investments are also earning 13%. What would we run into? 1,000 old investments improving 1 percentage point, plus new investment directly earning 13%. So that comes out to an increase of $23 as opposed to just $12 if ROI had remained at 12. And down below, again, we have investment in existing projects multiplied by current ROI, which is, the current earnings calculation. So we have 23 over 120, and the growth would have been almost just under 20%, 19.17%. So notice that the improvement from 10 to almost more than 19% is coming from two sources. One is the new investment earning 13%. Two, the old investments are also improving, creating 9 additional percentage points of growth in this year. So if we want to calculate the expected long-term growth in EPS, we need to be using these formulas. So reinvestment rate, again, is how much of your earnings are you keeping in the company, okay? So this is called the retention ratio. And the return on investment that we want to use in this case, so because you can have different reinvestment rates for if you're using, total return on investment or return on assets. But if you're doing this for EPS, so basically net income, you would use a different calculation. So reinvestment rate here is the retention ratio. How much of your current earnings are you keeping in the company, adding to retained earnings? So in that case, this is referred to as the retention ratio, and the appropriate ROI number is the ROE, return on equity. So net income over book value of equity. So if ROE is not increasing or decreasing, if it's constant, then the formula is nice and simple. It's retention ratio times ROE. So retained earnings. And notice that this is from the last period, T-1. So how much of the income of T-1 have we kept in the company, and multiply that by the ROE, which has not changed either. And for simplicity, the retention ratio can be replaced by the letter B. B times ROE will give you the growth rate in EPS, also the growth rate in net income. So from this nice simple formula, notice that we can extract some expectations. So proposition 1, the expected growth rate in earnings for a company cannot exceed its return on equity in the long term. Why not? Why can the growth in EPS not exceed ROE in the long term? because for growth of EPS to exceed ROE, what must happen? The retention ratio must be greater than 1. So what does that mean? Investors must be constantly putting more and more money into the company from their own pockets, not just from the net income. So they're keeping all of the net income, retention ratio of 1. In that case, G would equal ROE. But for G to exceed ROE means that not only are they keeping all of the net income of the company, but they're also adding additional equity from their own pockets. So investors are not expected to continue to add equity to companies forever. They may keep part of the net income of the company, but they will not forever continue to put money into a company. The reason that they're investing is to make money from the company. And that does not happen when they keep on just adding money into the company. So expected growth rate in earnings for a company cannot exceed its ROE in the long term. And almost always, the growth rate in EPS will be lower than ROE. How much lower depends on how much they choose to retain and add to the assets of the company. So let's estimate some numbers for a company. Here we have ABN AMRO, a bank, and their return on equity is 15.79%. And looking at their history, at their past, their retention ratio has been, so you can also calculate it as 1 minus their dividend payout. Also, you can use it that way. So if they've been paying out this much in dividends, so out of 245 of EPS, they've been paying out 113 of dividends. So about 47%. That means that 1 minus that, about 53, 54% almost, is their retention ratio. About more than 50% is being kept in the company out of their net income. If ABN AMRO can maintain its current ROE of 15.79 and its retention ratio of 53.88, then expected growth in EPS, according to the formula we just had, should be B times ROE, or 8.51%. Okay? Again, assuming everything is staying constant out into the future, this is what you would expect to see. Well, what if things change a little bit? Assume now that next year, ROE is expected to go up to 17%. So from 15.79 up to 17%, while the retention ratio continues to remain at the same level. We're still keeping just under 54% of the net income in the company. What is the new expected long-term growth rate in EPS? Be careful. It says long-term, right? Because the growth rate long-term will be equal to B times ROE. But just for the next year, there's going to be an interesting little change. So long-term growth rate is going to be 17% ROE, new ROE, times this retention rate of 53.88. So it will basically be equal to 9.16% if you do the calculation. But be careful, because this is the benefit brought by the new investments. But keep in mind that the old investments of this company are also going up to an ROE of 17%. So our old investments will also bring something extra, which will create a big jump up in next year. But after that year, it will slow down to 9.16%. So will the expected growth rate in earnings per share next year be greater than, less than, or equal to this estimate of 9.16? It will be greater than, because next year we get the additional benefit of the old investments also going from 15.79 up to 17%. So here just in the year where there is the change, you get B times the new ROE, retention times the new ROE, but you also get this second term, which is the improvement percentage in ROE, and that is a significantly higher number. So in the next slide, we'll see the numbers for ABN AMRO. So just coming from B times ROE, we get the 9.16. But from the improvement in the ROE of old investments as well, we get this extra term, 7.66, which means that just in year T+1, the growth rate will spike up to almost 17%, and then it will come back down and settle down at 9.16%. Yes, a 1.21 percentage point improvement in ROE almost doubles the growth rate for the next year from 851, what it was initially, to 1683 for 1 year, and then it comes down to 9.16 forever. So I'll stop here and we will continue in our next class. I'll see you then.